Hi, everyone, and welcome to our 16th annual Investment Manager webinar. We're really excited to have you all here today. We certainly appreciate the partnership with our asset management community, as we truly think it's an important and critical part of our success as a company. Our goal today is to really provide an update on NEPC as a business, our investment team, and then provide some additional insight on how we evaluate investment strategies to hopefully better inform how you engage with NEPC and our clients. In addition, we're excited to present the biggest takeaways from our AI survey, which canvassed a number of different asset managers along with several different institutional clients on the ways in which they're currently leveraging AI. I'm Will Forde. I'm a partner here at NEPC and lead our investment manager research team. I'm joined today by Rosann Halleran, who's the senior investment director covering the non-U.S. developed space. She'll walk us through our detailed investment process. I'm also joined by Colton Lavin, senior investment director within our private debt team, who will talk about some of the biggest trends within private credit, which is certainly a topical asset class these days. And then lastly, Alix Stewart, who's a consultant in our Endowment Foundation practice group, who will share how institutional investors are leveraging AI. With that, we want to provide a brief business update on NEPC. We remain a privately held company with 50 plus partners, really focused on maintaining and growing our business. Our continued independence really allows us to put our clients and their interests first. And to that end, 100% of our revenue comes from advisory and discretionary investment services. We're very fortunate to be one of the largest consulting firms in the industry with over $1.9 trillion in assets and just over 400 clients. These clients are serviced by our consulting group, which is split across 7 distinct practice teams, really designed to be specialists for the different client types, all of which you can see on the right-hand side. Unlike many of our peers who focus maybe on 1 or 2 distinct client segments, our source of revenue is very diversified across all these different areas, and that's served us well. And it's allowed our business to remain stable even during pretty turbulent times. While many things at NEPC have remained the same, some things have evolved and changed. We've embarked on a phased leadership transition as Mike Manning has moved on to being a senior advisor, supporting several large client relationships and big strategic initiatives. And as a result, Tim McCusker, effective January 2026, has moved into the role of president and then will transition to CEO effective January 2027. As part of that succession plan, we also announced Sarah Samuels moving into the role of Chief Investment Officer, overseeing our entire investment team, including our outsourced CIO group. And lastly, I was promoted to head of investment manager research, stepping into Sarah's former role, overseeing our manager research process across both marketable securities as well as private markets. Tim, Sarah, and I were really excited about our new responsibilities while still preserving the culture that makes NEPC different than our peers. As we all know, it's been a very interesting time to be allocating capital across capital markets. And given this, we thought it was really timely to share some of the key challenges for institutional investors based on the 2025 Greenwich Associates survey. And you can see some of the results here. Some big takeaways. First, asset allocation and market volatility really remain the primary challenges for institutional investors. And we think that really jives with what we've seen across our client base, where folks seem to be grappling with broad asset allocation decisions, such as, what's the right mix between public and private allocations, given the lack of distributions from the private markets over the past several years. Or secondly, some of the challenges between the relationship of equities and bonds. And does traditional fixed income still serve as a true diversifier, or is that better suited through a different allocation? I mentioned market volatility. Of course, that's been pretty prevalent. And we get the sense that clients, institutional clients, are trying to figure out the best way to absorb an ever-changing market with AI as a big theme and geopolitics, while ensuring that they're not losing track of their long-term targets and what's best for the long term for the portfolio. Some of these challenges dovetail pretty nicely into the expected asset allocation shifts over the next 3 years. And maybe some big takeaways on this page. First, on a net basis within equities, allocators plan on reducing their active equity exposure. That's not a surprise, and we think it's likely driven based off of the strong returns from the public equity space, as well as some headwinds from active managers. Second, despite the headlines, many are still looking to increase their private market book, particularly within private equity and private debt. This is a trend that we've seen in spades, although I think investors still remain pretty wary about the top end of their allocations, just given lower expected returns in the space, less distributable capital, and just a groundswell of new capital chasing deals. And then lastly, for the first time in a long time, fixed income allocations are increasing and back in vogue, particularly in the more niche areas of the market like credit opportunities and more structured credit. So in order to meet these ever-evolving challenges for our clients, we have to continue leveraging and developing our own assets. I've said this last year and continue to believe it. The biggest asset here at NEPC is our people. And I wanted to highlight our incredible investment team while giving you an inside look into our structure and their area of coverage. And this slide shows our investment leadership group led by our newly appointed CIO, Sarah Samuels. And then you can see here our top-down and asset allocation positioning and assumptions are developed by Phil Nelson and his group. In the middle of the page, you see our investment strategy team. This is the group responsible for implementation and manager research. Our investment manager research team interacts probably the most with the manager community here at NEPC. And we're really responsible and tasked with curating our focus placement lists, which are our highest conviction strategies that go through our full due diligence process. The group is structured predominantly by beta groups across both public and private markets. For example, Dilari Pancholi leads credit and diversifying strategies. You've got Josh Beers overseeing private equity, Oliver Fadley within private debt, and then Matt Ritter leading real estate and real assets. I think one important thing to highlight here is that each team leader across investment manager research is a partner or principal at the firm. We believe this ensures greater stability across the firm to our client base and is a signal to the market for how much we value investment talent here at NEPC. 2025 was a banner year for us, and 2026 is shaping up to be the same. We're a pretty busy group overseeing over 10,000 plus investment strategies across the 400 clients that we have. We conducted 700 searches, and we have generally over 3,000 plus manager meetings, and that was all done in calendar year 2025. Part of our work is also generating thought leadership and sharing our investment insights with folks outside of the walls of NEPC. So we've also been busy on that front, and we wanted to highlight some of the thought leadership that we've been able to publish, including our new 2026 annual letter authored by Sarah Samuels, which should give you a flavor of some of our implementation and asset allocation thoughts and some of the big trends driving markets. So with that, I will get out of the way and pass things over to Rosann Halleran to talk in more detail about our investment process.
Thanks, Will. So I will jump right into our investment process. You can see here from this slide that moving directionally, we start with universe screening, moving all the way through peer review. Universe screening, especially on the long-only equity and fixed income sides, starts with data from eVestment. So having that data updated and accurate is really important to be included in our screens. We are conducting those by universe, and those give our researchers initial quantitative analysis that they can then decide where they want to focus their efforts. After a researcher has decided where they'd like to focus efforts for sourcing new ideas, they're then moving to our investment framework. Our investment framework gives us hundreds of ways in which we can analyze and rate investment managers, and we are digging in on areas from the firm, strategy, team, process, and then also we have more ways to score performance. With that analysis, we are then bringing it through for a full rating. You will see the framework will be discussed further in the next slides, and then we're bringing it to a peer review that'll go to our committees for approval of the ratings a researcher has come up with. You can see this is the framework. This is where we take our deep dive. We are moving from that quantitative analysis into the qualitative. The quantitative analysis, we are looking at returns in various ways. We are looking at performance at an absolute level. We are looking at compared to a relative benchmark, appropriate relative benchmark. We are reviewing peer comparisons, and then we're assessing the manager's likelihood of success. We're looking at luck versus skill. We want to know if a manager's track record is truly attributed to skill. Another area that we're looking in within performance is factor attribution. That has been really important, especially in times of market volatility. That allows us to strip out both headwinds and tailwinds for strategies. So for the past few years, where momentum has been quite a tailwind and quality has been quite a headwind, we are able to look at what a track record would look like if those factors were able to be stripped out to see a manager's true alpha. After we have gone through that quantitative analysis, we'll then move into the qualitative analysis. And that's where you'll see the due diligence questionnaires from us. You'll also be working with us. We'll be setting up meetings with various team members as we assess a strategy. We are truly trying to dig in on a manager's edge. We will ask you what you think your edge is. We know that you're compared to very impressive peers. We want to know what differentiates you from those peers. We are also forming our own opinions on what are your true differentiators. Within that framework where we're forming those opinions, we are asking a lot about people. We want to know the culture of the firm. We want to know the culture of the team. We are asking what incentives there are for members of the team. We are asking how ideas are sourced, how analysts get ideas up to portfolio managers, and how it's determined how they get into portfolios. We are digging in to the full process. We want to know about portfolio construction and constraints around a portfolio, which all helps us inform what we would expect from a strategy. We are also asking a lot about risk management. We want to know how risk is handled. We want to know if it's done in the team where risks are assessed and evaluated, or if there is an independent team that is giving managers the feedback about where their risks may be unintended in the portfolio. With that, once we feel we have a strategy that is successful and can be successful, we also are going to dig into alignment of incentives. This is really important at the firm and strategy level. We want to know, once we have a strategy we feel will be successful, we want to know it's also at a firm that can weather, say, market downturns, which might lead to outflows. So we're digging into viability and profitability. We're digging into business strategy. We want to know if the firm is reliant on one strategy, how they think about that, or if the firm has multiple ways to win, and therefore, and how they think about growth within their firm. We spend time on succession planning. We are looking at succession planning both for the strategy and the firm. We want to know that the individuals we identify as key individuals, it's thought about in both the strategy level and the firm level. What will happen if those individuals retire or decide to leave the firm? Because we want to know that a strategy we view as successful can also be successful if an individual we identify as a key individual leaves. So moving on to the next slide, we're just going to show you the framework. This is a roll-up of that overall framework, and you can see some of these areas that I've really identified as important. Within people, we are also looking at turnover. That's not just going to be turnover of key professionals. That helps us evaluate culture, because if turnover creeps up, we want to know what's going on. We want to know that everything is okay within the team and that we believe the culture is positive. So once we have evaluated all these areas and given the underlying scores, you can see in that middle blue at the top, there's an area for analyst opinion. And you can see that that area has a higher weight than all of the others. That is where our analysts, after they have learned everything they have learned through various due diligence questionnaires, through various meetings, through all the analysis they have conducted, that is where they rate the strength of the firm and strategy and how successful they believe it will be. And this overall framework will then inform that investment rating. You can see from this example, the investment rating is a 2. That is going to be a focus placement recommendation. So it will go to committee. If approved, it will go onto our focus placement list. And if we move on to that next slide, we're going to see here are our investment ratings. You can see the investment ratings go from 1 to 5. As I mentioned, 1 and 2 rated are focus placement list strategies. 1 rated is going to be a best idea. 2 rated is a strategy where we have a positive view. We believe there's a clear and competitive thesis, and we do believe it's appropriate for use in client portfolios. A 3 rated strategy is a strategy where we have a constructive view. We do believe they can play appropriate use in client portfolios, but they're not going to be on the focus placement list with strategies that we recommend for search activity. A 4 rated strategy is one where we have an unfavorable view, and we would recommend clients not use that strategy. And a 5 rated is one where we have significant concerns. If a strategy is 5 rated, likely on the right-hand side where we have our due diligence statuses, it would also get a terminate recommendation. Those due diligence statuses are statuses we have on all strategies that are focus placement list and where we have client assets. So a no action or FYI means either there's nothing actionable at this firm or strategy level, and FYI is something that's been brought to our attention that we want to make aware. We want to make our clients and consultants aware, but we do not believe it is a concern, whatever the information is. So we just issue a due diligence FYI that goes through committee. If we issue a watch, something has been brought to our attention where we want to monitor it more closely. It does not mean that existing clients need to move away, and the strategy can still be included in our search activity. We're just letting existing clients and any client that might want to use that strategy know what it is that we're monitoring more closely. A hold recommendation is something where we're going to be monitoring it further than we would a watch. It's something that at that point we're going to say we do not want new client assets moving into this strategy based on what we have learned, but we are not recommending existing clients move away. We're going to be monitoring it closely to decide what next steps need to be taken. And if we issue a client review or terminate recommendation, that is going to come with a 48-hour letter out of NEPC research with a clear understanding of what has happened, what we believe next steps should be. That client review is one where we're going to ask clients to work with their consultants to determine what they would like to do based on all of the information we have available. And the terminate is one where we have lost confidence and we are going to recommend that clients move away. And now I'm going to pivot into discussing our search activity. So you can see here, search activity from 2025. It goes to what Will was speaking to, of where we're seeing some client interest. This search activity is bucketed by long-only equity, long-only fixed income, and then alternatives. And you can see those strong numbers for activity within the alternative section, particularly within private equity and private debt. So moving to our next slide, this is going to just show you that historical activity. The top is historical assets placed, and the bottom is total number of searches, where again, you can see particularly in that past 5 years, Searches within long only and equity and fixed income have been fairly consistent, and searches within that alternatives area have really increased in the past few years. And with that, I am going to turn this over to Colton Lavin, who's going to discuss private debt.
Thank you, Rosann. I'm going to spend a couple minutes on private debt trends, and more specifically, what topics our clients have been asking about the most lately, additional focus areas for NEPC right now, and where we think there's some interesting opportunities in the current market environment. But to first quickly level set, NEPC clients have approximately $40 billion in private debt assets. As was mentioned earlier, NEPC is a very diverse client base made up of many different types of investors, and we seek to partner with our clients to help build customized private debt portfolios tailored to their specific needs and constraints. It's not a one-size-fits-all approach, and as a result, our clients have a broad mix of private debt exposures across different types of strategies, geographies, and vehicle structures. As far as what clients have been asking about lately, first, semi-liquid vehicles. NEPC clients have very little exposure to semi-liquid vehicles, so the run on redemptions that we saw in Q1 and Q2 doesn't necessarily directly impact our clients, but there are secondary impacts we're monitoring and keeping clients appraised of, particularly with GPs that we have exposure to that also offer separate semi-liquid vehicles. Just stuff like, is the semi-liquid vehicle now taking time and resources away from managing their other funds? Are clients protected from an allocation policy perspective? Or if a GP does a secondary sale from their semi-liquid portfolio, just to fund redemptions, generate liquidity, how does that impact the drawdown fund? The next topic is software and tech. This impacts all asset classes, but it's obviously been in the news a lot with private debt specifically, just given kind of the sizable allocations of that sector, particularly in direct lending. We've been doing exposure analysis on our clients' portfolios, and they're actually better positioned than the broader market as far as kind of being insulated from potential AI disruption. And we also identified software and tech as getting a little bit frothy in private debt 3 to 4 years ago. And at that time, we mapped the market for different ways to play the other side of that trade, just in case there ultimately was any volatility or issues in the sector. So our clients have some funds that stand to capitalize on the current market situation. The third topic is valuations. Some clients have questioned just the validity of marks, given some discrepancies in what different GPs may hold the same investments at, as well as a couple of deals that weren't really getting marked down until there was kind of sudden steep markdown when things really went sideways. But given there is a component of GP discretion in valuations, there always is going to be some likely kind of discrepancies amongst marks. However, the growth of the secondary market in private debt, as well as just improvements in data availability in general, should help improve price transparency over time. We're in constant contact with all of our managers to understand all the marks across their portfolios, but in general, it would benefit GPs to try and be proactive and be as transparent as possible with all investors moving forward, because relationships really matter at a time like this, especially when some people are starting to question kind of their trust in the asset class. And last topic is geopolitics and inflation. A lot of managers cut energy from their mandates in the 2015 to 2017 timeframe. But there are secondary impacts to the conflict in the Middle East that we're monitoring as far as kind of impacts on client private debt portfolios. Some of that stuff includes input costs, supply chain disruption, and ultimately how it impacts the Fed's decisions around interest rates. In addition to what clients have been asking us about, NEPC also has some other topics that we have a heightened focus on right now. First, value traps. One example of that being aggressive EBITDA adjustments, which tend to give kind of a false sense of security. So we seek to partner with GPs that maintain strong credit underwriting and aren't overly reliant on financial engineering, continuous sponsor support, or just an exceedingly favorable market environment overall. Second, hidden risks. This includes deals that were done in 2021 and 2022 when there were record valuations and also before the rate hikes, which caused unexpected jumps in interest expense. It also includes stuff like amend and extend and PIK being used to just largely kick the can down the road, which keeps default rates low and masks some of the underlying stress in the market. Third, manager consolidation. Several dozen private debt GPs have been acquired in recent years. Not all acquisitions are created equal. So making sure there's still strong alignment with investors, the talent is retained, there's no strategy drift associated with those acquisitions. And then lastly, fund term duration, due to whether it be the muted M&A environment, managing some troubled assets, and or just difficulty in general with portfolio construction and management. There's many funds in the market that haven't been able to fully wrap up in their stated fund terms. And the constant inflow of extension proposals from GPs can be a bit of a nuisance, not only from an administrative perspective, but also from an opportunity cost of clients not being able to reallocate those dollars into new investments. And then wrapping up with some interesting opportunities right now. First, complexity. A lot of the issues being seen in the market have been in the most competitive segments of the asset class. And areas that require specialized skill sets and networks tend to be generally more insulated from the negative aspects of competition. And a couple of strategies that fit that mold are asset-based lending and sector industry specialists. And then given some of the stress in the market, both above and below the surface, it's an interesting time to consider allocating to opportunistic credit or special situation strategies that can capitalize on that dynamic. And then core defensive income. There's still plenty of high quality managers doing a great job in direct lending, but manager selection is paramount. And we seek to partner with GPs that really got a strong demonstrated track record of protecting capital and the resources and capabilities to do so on a forward-looking basis. And with that, I'll pass it to Will and Alix to discuss AI.
Thanks, Colton. As Colton noted, we're going to pivot a little bit away from who we are and what we do here at NEPC and talk a little bit more generally and broadly around AI and its impact across our industry. We actually shared some of these slides with our clients at our client conference back in May, and we thought there were enough meaningful takeaways from that session to also share with this group. So we believe that the asset management industry has really benefited from decades worth of tailwinds since the global financial crisis. Think about lower interest rates, pretty consistent GDP growth, and just strong capital markets generally. But of late, many of those tailwinds have reversed to headwinds and or come under a lot of pressure, adding to some ongoing structural shifts in the marketplace, such as the continued march from active to passive management, from traditional assets to alternatives, and just downward fee pressure across the board. So you have these rising industry costs and more unpredictable revenues for asset managers, and we believe that's resulted in a newer type of crisis, and we think that's more of a margins crisis. There was a recent McKinsey study that noted that margins for North American-based asset managers have declined by 3 percentage points over the past 5 years. We've seen symptoms of that more recently across our investment manager research team. We've seen more consolidations in the industry. Colton touched on that in the private debt space. We've seen quiet and sometimes louder layoffs across our asset managers, and an increase in strategies being closed. So we believe the industry is in the middle of a pivot point, so to speak, and they really view AI as a potential once-in-a-generation opportunity to increase efficiency and break out of some of these rising cost structures and really return businesses back to a more profitable place. In typical NEPC fashion, though, we trust but verify, and we felt compelled to do our own research on some of these trends and get a better sense of AI usage across the asset management community. So we asked a number of questions of our focused placement list managers with the goal of better uncovering who's using AI, understanding how they're using it, and trying to get a better understanding what have been the best use cases for realized benefits. And this is a quick snapshot of that methodology. We reached out to over 230 different firms and got responses back across both the public and private markets and hedge funds totaling well over $100 trillion in assets under management, and including a number of the firms likely on today's webinar. So we believe we've got a wealth of data to share with you today, and then also to leverage moving forward. So here are some of the results. First, unsurprisingly, AI is everywhere. That was definitely a common theme throughout the survey, but we did note that it was certainly less prevalent where we believe it matters the most. Clearly, as you get closer to the actual management of capital and investment decisions, it seems like AI usage decreases. For example, 82% of respondents stated that AI tools are being used, but for general research purposes. But only a third of respondents are using it today for trading and risk management. So the moving and management of capital clearly isn't as impacted from AI. What was interesting was also that 65% of respondents noted that their portfolio management team is currently utilizing AI. When we dig into that a little bit more, it's clear to us that AI is really being used for more targeted use cases from that group, like building financial models and just, again, broader general research. So the big takeaway here is that AI isn't necessarily transforming the investment landscape today, but it does seem to be transforming everything around investing, and that's an important trend for us to be aware of. Most firms are experimenting with AI, but very few have it fully embedded into the core of its business and investment platform. Clearly, as you can see here, the majority of asset managers are deploying AI for targeted use cases and/or individual tasks or workflows for specific employees. This likely explains the stat that I personally was pretty surprised by in the survey, and that was that a third of the respondents who use AI are very confident in the explainability and interpretability of those results. For newer technology and something that's moving so fast, I was surprised by how high that number was. We believe firms have this confidence in AI because they're constraining it. They're using it for targeted use cases, and that's clearly in the way in which they're gaining confidence. We also looked at what tools are winning. Here you can see general purpose large language models are used the most. So think about tools like ChatGPT. And then you see nearly a third of respondents are using vendor embedded AI, which have AI capabilities built directly into third-party platforms or software that asset managers already use. So, Microsoft Copilot in Excel or Outlook, or something to that end. Just a quick note, not a ton of folks are using internally built models. I will say that is not rare for the systematic and quant managers who have been using large language models since the early 90s as really the core of their engine, alpha engine. 0% of firms indicated that they're ready to use AI for final decision-making. We're clearly not there yet. The biggest benefits from using AI, we believe, is likely within research, where time is really expensive, but decisions still need to be made by humans. And you see that come through pretty clearly here in the results of this survey. So with that, hopefully that was informative on some of the big AI takeaways across asset managers. I will pass things over to Alix to give you similar insights, but across institutional clients.
Thanks, Will. NEPC also conducted a survey on AI of our own clients and to see if there were some similar themes between investment managers and asset allocators. The survey reflects responses from 45 NEPC clients, and those responses span from groups like endowments and foundations, public pensions, corporate plans, healthcare systems, private wealth, and some others. We also have a wide range of asset sizes represented in the survey responses, from those managing, sub 500 million to those managing over 5 billion. And that diversity is really important because one of the clearest takeaways from this work is that there is no single institutional investor AI story. The adoption, comfort, and use cases vary meaningfully depending on the governance structure, regulatory exposure, and even staffing models at each of these groups. What we see very clearly on the next page, and this is reflected both in the survey and across the broader industry, is that AI adoption today is overwhelmingly operational before it is investment driven. Across plan types and asset sizes, the most common use case is administrative and operational efficiency. And you can think of these as things like drafting, summarizing documents, any type of workflow automation or research organization, and internal productivity tools at the client level. When we look deeper into the data and isolate responses by plan type, one pattern stood out pretty clearly that private wealth organizations or high net worth groups show the highest relative use of AI in their investment research, while groups like public pensions and Taft-Hartley plans are materially more conservative. And that lines up closely with differences in regulatory scrutiny and some governance layers that exist across client types, as well as their tolerance for experimentation. When we looked at the data by asset size, we see a bit of a middle market pause. Organizations in the 500 million to 2 billion range, as far as assets they're managing, are on average the least likely to be using AI at all versus their smaller and larger peers. And a possible reason for that is that they're large enough to be cautious, but not large enough to be absorbing those experimentation costs very easily. What's notably smaller but not absent is AI use in investment research and analysis, and that distinction matters. The story here is not that investors are ignoring AI, it's that they're being very intentional about where it sits in the process. So we asked that follow-up question about AI and its role in investment decision-making, and we found that responses were pretty evenly spread across the options there, ranging from those not using or considering AI at all in their process to those that are really actively piloting tools to replace existing workflows as it relates to their investment decision-making. The real takeaway from this question here is that very few respondents across any plan type or asset size are fully delegating investment decisions to AI. Even among the most forward-leaning organizations, AI is described more as an assistant and less of a decision maker. And that theme echoes with what we heard repeatedly in external research as well. CIO level conversations consistently describe AI as a junior analyst. They're really excellent at scale, at speed, at pattern recognition, but still reliant on human judgment for context and accountability. When we step outside the NEPC client survey and look across the broader institutional landscape on the next page, the conclusions are quite consistent with what we found internally. First, operational efficiency is the clear entry point. Whether it's research synthesis, document review, meeting notes, or screening large data sets, AI is being relied upon to save time rather than generate any form of standalone output. Second, investors are very deliberately cautious about system-level risks, things like data leakage, bias, or even regulatory exposure. The World Economic Forum frames AI not just as a company-specific risk on investments, but a portfolio-wide, non-diversifiable issue that's affecting labor markets, governance, and even trust in the data that's out there. And third, human judgment remains non-substitutable at these institutions, particularly in areas like manager evaluation, mission-aligned investing, and anything reputationally sensitive. So I'll close this topic up with what I think is the most important synthesis from our work on the next page. And that is that operational adoption is clearly moving faster than investment delegation, and that appears to be by design, not by accident. Across plan types, asset sizes, governance models at the client level, investors are prioritizing accountability and transparency, as well as, really importantly, human oversight over speed or novelty in the use of AI. And in many ways, that caution reflects good fiduciary practice, not a resistance to innovation. So the key question for most organizations isn't, should we use AI? It's where does AI support our people without weakening our decision-making or governance? And that's the lens through which we think this conversation will continue to evolve at the institutional investor level. So that wraps up our webinar for today. Thank you all coming to NEPC's 16th annual manager webinar. We really value our partnership with the asset management community, and we hope you found today informative. A video of today's call will be posted to our website early next week. So for those that want to share today's discussion, you'll be able to access that in a handful of days. And we look forward to next year's webinar and hope you all have a great rest of your day. Thank you so much.